Hi, my name is Sam Chiodo. Tonight the topic is retirement planning. It's a topic that I've been having with clients of mine for the past 40 years. And it has a particular characteristic tonight based on an article that I recently read. So the article that I read said that you need to have 80% of your pre-retirement earnings as your post-retirement earnings. Now, I've got some very brilliant scientists, nerdy-like people that follow me. I'm sure they're hyperventilating because of the 80% number. But the reason I was attracted to the number is not because of the number itself, but the fact that they didn't underplay the concern that was being expressed. To mean, they're stressing that post-retirement, to live in dignity and have a quality of life that you've earned, should be at that level, 80% of your pre-retirement earnings. So I was introduced to an idea the other day, and I'm going to shape it in the form of, imagine with me a retirement plan that does the following. A retirement plan that has no annual contribution limits. A retirement plan that has no downside risk. A retirement plan that provides you with tax-free income for the duration of your retirement. Imagine also that the assets are creditor-proof and asset protected. Now, if you will, further imagine with me that this is a plan that, should you qualify, if you put away $1, the plan itself will put away another $3 on your behalf with the characteristics that I just articulated. So here we have a plan where you're contributing, you're adequately funding your retirement. Some of the risks that are inherent when you do retirement planning is you worry about, do I have enough money to put away a sum that would provide me with a meaningful enough post-retirement income? Well, if you can imagine this plan, that for every dollar that you put in, they're going to put $3 away for you as well, assuming you qualify. So that takes care of the capital risk. Capital risk to mean, do I have enough money to put away? Also, what happens if I live too long? Or what happens if I become critically ill? Or what happens if I'm in needing of long-term care? This specialized policy affords you the opportunity to monetize a portion of the death benefit to pay your living expenses if you need long-term care. It also pays your expenses if you need critical illness. Now further imagine with me that the annual premium, that the amount of money that you're going to put away is $50,000 a year. So in year 1 and through year 5, you are effectively obligated to put away at least $25,000. But for the purpose of this example, let's say you're going to put away $50,000. So year 1 you put away $50,000, year 2, 3, 4, and 5 you put away $50,000, and you are now done with this retirement plan. No more funding is required by you. However, contemporaneously, there's a bank, and the bank is going to lend you $50,000 a year for year 1, 2, 3, 4, and 5. So in those years, instead of putting away 50, you're going to be putting away 100. But I just told you that you were done after the 5th year. Yes, and in years 6 through 10, the bank puts $100,000 away for you each year. The money then sits in the policy until the 15th year. In the 15th year, the bank, who basically lent you that money, wants to collect back their money plus approximately 2% interest. So in the 15th year, they come and they gather their money. They take it from the corpus of the policy itself. It leaves you a residual. That residual continues to earn interest at the indexed rate, and at your age 65, you start to take distributions from the policy. We can get into this at a later date, but distributions properly structured from a life insurance policy are tax-free. Those distributions become your retirement distributions. So, did your money make more than the 2% that you were being charged? The answer is a question. Where did you invest the money? The investment options of the policy basically allow you to invest in index. It's a Bloomberg index, it's a PIMCO index, Standard & Poor's 500 index, or a combination therein. It's a synthetic. You're not really in the index, they're mirroring the result or the blended result of those indexes on an annual basis. So to the extent that you've earned more than the 2%, then there's adequate funds to not only pay back the bank, but leave you with a healthy balance in your account. Because remembering that you didn't put away $1, you put away $3 with the bank's help. So the threshold question now is, do you qualify? And to qualify, you have to be 51 or younger and be making at least $150,000 a year. W-2, Schedule C earnings to justify to the bank that you qualify. Let's talk about the loan for a moment. It's not a typical loan. There's no loan documentation. There's no collateral that's posted. And the only collateral that is the loan for the loan is the policy itself. Now that speaks to the other risk that you may be assuming, which is credit risk. Who are these people that are doing this lending and taking back the money from the policy? One is a major insurance company with over $1 trillion in assets, and the other is some large money center bank. The topic of retirement is an important one, and due care and deliberation should be taken. If you'd like to better understand and acquire more information about it, send me an email, go to my website, samchiodoagency.com, or follow me on LinkedIn or Facebook. I look forward to talking with you soon.